Alright, this is the chapter 6. It's the meaning of measurement of risk and return. Meaning and measurement of risk and return. And we're going to look at stocks and stock portfolios. And to kind of try to understand, one, why we have interest, and two, how to diversify to maybe lower that risk and then lower the interest. So here's what we're going to go over. We're going to look at define and measure the expected rate of return of an individual investment, and then we're going to look at the riskiness of an individual. We're going to compare historic relationships, between rates and the capital market. We'll look at 6 different categories. We're then going to look at some diversifying, and finally explain the relationship between an investor's required rate of return, and the riskiness of the investment. And I think you will find there's a direct correlation. The higher the risk, the higher the rate of expected or required rate of return. So, as we go down through here, we need to think of the 2 principles. Risk requires reward, and cash flow is what matters. So you have cash flow with all stocks. You have, one, the gain that you get each year, typically when it goes up in price on the market, and you have a dividend return. So learn to measure those. And the key terms, most of these will be fairly new to you. The expected rate of return isn't, but the holding period, the non-diversifiable risk, the beta, that's going to be new. You have a security market line. Standard deviation shouldn't be new, just maybe in the context that we're looking at it, may be somewhat new. And unsystematic risk and systematic risk. All of these are relatively new. There's the CAPM, Capital Asset Pricing Model, which is kind of fun to play with. So we're going to cover all of these in one place or the other, so you'll get kind of comfortable with seeing them bounced about. Then we're going to start right off with calculation. So we're looking at, remember back here in the terms, we talked about a holding period return. Well, we're going to find out what that is. We bought some shares for 1970. In May 2007, we sold them in 2009 for $32.32. And along the way, the company paid us 8 cents on every quarter during the last 2 years. Alright, so, did I have a holding period dollar gain? Well, if I take $32.32 plus that 8 cents for 4 quarters, that was my overall gain, then minus the cost, I would then have a holding period gain of $12.94. And my rate of return, for that holding period, if you take $12.94 and divide it by the cost, you'll end up with 65.5% return. So that's a pretty good return, right? So that's how that's figured, though. So kind of keep that one in mind. And now we move on to the expected cash flow. And expected cash flows deal with probabilities. This is saying that X, which is cash flow, equals the sum of the probabilities of the cash flow. Okay, that would be in mathematical language or statistical language. But if we look at, let's put it in everyday language. We have 3 scenarios, and these are 3 states of the economy, and there are probabilities for each of these states. And this is the cash flow we're expecting, so, if I want to know, these are the probabilities, and these are the returns. This is going to be a return on $1,000. So let's go and see what we've got. We have expected cash flow, okay? This is a $1,000 investment. There's a 20% chance of $1,000. There's a 30% chance of $1,200, and there's a 50% chance of $1,400. That would mean the expected cash flow is $1,260 on that $1,000. Now, just let that settle a bit. And our expected rate of return can also be figured that way. It looks like 2% on 20, or yeah, 20% times the 10% rate, 30% times the 12% rate, and 5% times the 14% rate gives us 12.6. That's the expected rate of return. And we're going to use that in an activity we do in 6.1. So there are three important questions to ask here. Is 1, what is the risk? How do we measure that risk? And will diversification reduce the risk? And that's what the whole chapter is about. Find that risk, measure it. How can we diversify that risk out? So risk defined as the potential of variability in future cash flows. And if anybody has watched the stock market, you know it goes up and down. And the variability of stocks in that up and down motion is the risk. So the wider the range of possible future events, the greater the risk. Usually common stock is more risky than returns from a savings account on a bank. Why? Well, the bank is not on the market and it's not being driven, okay, by events happening in the world. The bank is relatively steady and pays a steady amount of interest. And it's also guaranteed. So the bank's going to have a lower interest rate, pay a lower interest rate for an investment than the stock market does, because the higher the risk, the more investors want in return. So let's look at two investment options. You're going to invest in a treasury stock that offers a 3% return, or you're going to invest in a local publishing company with an expected return of 15%, based on the payoffs given on the next slide. Okay, so there's a 10% chance you'll get nothing. There's a 20% chance of 5% return, a 40% chance of 15, a 20% chance of 25, and a 10% chance of 30. Those, okay, are the probabilities of the rate of return. In the treasury stock, 100% chance of 3%. So if I look at what is the probabilities and multiply that out, I end up with a 15% expected rate of return. I have the 3% here. And this kind of maps out like this then. If you put this into a graph, there is absolutely 100% chance I'm getting that 3%. Now here we've got it graphed, and you know what happens with the bell curve. There's a certain percent that ends up being the majority of it. So now you have to look at it and say, okay, what is the variability? What's the standard of deviation of all of this, so I know what falls within that range? So that's what we do next. We figure out the variability. And it gets kind of complicated, but just bear with it. Okay, so first of all, here are all my stocks laid out. Here are the probabilities, and oh, here's the rate of return, and here's the probability, sorry. So first of all, we're going to multiply these together and come up with this. And we have a 0, a 1, 6, and 5%. Now, we need to find the difference, okay, of these, of B, okay, minus the rate. And then we're going to take it to the second power. So the rate is the 15%. So now we need to find the variability. We have the expected rate. If we add this up, we'll come up to 15. So if we subtract 0 from, or 15 from 0, we'll come up with a negative 15. We'll turn that positive, and we'll take it to, and we'll square it, which gives us 225. And you do the same thing. 5% minus 15% gives us 10. This gives us 0. This gives us 10. And this gives us 15. So then you square all of these, and then you multiply them times this probability again. Okay, if you add these up, okay, that comes to 85. That's the variability of all of these. Now comes the kicker. See, we're going to add these all up, and the 85%, we're going to get the square root of that, and this gives us the standard deviation of 9.22. Now, when you look at it, you find out there's a almost 67% probability that the actual returns will fall between 5.7, and 24. That's a really long range, okay? I mean, that's a very big variability as far as the possibility of where it's going to lie. So the risk is rather high if you're just looking at it. But that's relative, because you have to compare it to something. So to get the full picture, you need to consider not only the standard deviation, but the expected rate of return. Is that within reason? And you need to compare it to maybe another stock that you're thinking about. Okay, and then you think, what is your attitude towards risk? Is that 15% worth it? As you think about that. So let's look at the typical returns. I think this was over 75 years, something like that. So you're typically large company stocks, you get 11%. Well, the 15% was better than the 11%, right? But if there's caps, small caps, they get 16% return. And that's because of the uncertainty in a small company. Corporate bonds had 6.2. Government bonds, 6.1. Treasuries, 3.8, and our inflation rate was 3.1. Now here's the standard deviation of all of these, and then here's your average returns. Now look at this. I mean, that 15% is even higher than the small cap stock. So that may be a well worth investment if you can handle the risk. So the direct relationship between risk and rate. Common stocks provide a reasonable hedge against that rate of inflation, right? There's three. Yeah, the rate of inflation is about 3.1. Okay, the risk is 7, so it's pretty well covered. As you look at this, this was fascinating to me as I read this. 23 out of the 83 years had negative returns, large stocks, while Treasury bills generated only 1 year. So you can see the difference in risk between those two items and why the Treasury bonds are called the risk-free rate. So how do you get rid of risk? Well, you diversify. And you combine several assets together. An example would be stocks or bonds and T-bills all together. Or you can invest in 30 different stocks, and that will pretty well bring down your your risk, but you have to be careful about what stocks you choose. So the total risk of portfolio is due to two types of risks. You've got that systematic, we talked about that, that's the built-in market risk. And you have the unsystematic, and that's what's unique to your company. And you can kind of control those. Only unsystematic risk can be reduced or eliminated through effective diversity. And you can see that right here. Right here. This is the system risk. It's going to be there no matter what. It doesn't matter what you do. But this risk here, you can get rid of. This is that unsystematic. Now watch what happens. If you get the right stocks and you get up to 30 stocks, there's literally no unsystematic risk there. So all you're left with is this systematic. So you have to select the right stocks, and they have to be stocks that are correlated. If you select two stocks that are perfectly correlated or moved together, diversification has no effect. But you want to get stocks that are negatively correlated. So when one's going up, the other one's going down. That protects you. So when one's going down, the other one's going up. So you're taking out that risk that you've got built in there. So you have to be really careful to get the right ratio of negative and low or low positive correlations to get any effects of that diversification, which means you have to know your stocks. And if you look at Google, you'll see a direct look at this. The stock, this S&P, when it goes down, Google goes down, right? Maybe not to the same degree, but it kind of is correlated in a downward, upward type situation. So if you come to the next slide, it talks about how much. So let's also go back and look at the standard deviation of these differences. And Google has a 9.9 standard deviation, and Standard & Poor 500 index has an 8.3. So Google's got a little bit higher risk factor built into it. And as I noted, as you look at this, you could see the up and down. They kind of go together, but not exactly. There is a moderate positive correlation between the two. So you would, if you're going to invest in Google, you want to find a stock that kind of goes the other way, so that when the market goes down, it's going up. So you have to balance your portfolio to match that. So this is all put together with something called beta. Okay? A stock with no beta, or a beta of 0, has no systematic risk. Okay? It does not follow the stock market. It just kind of goes on its own. But a stock with a beta of 1 has a systematic risk equal to a typical stock on the market. A stock a beta exceeding 1 has a systematic risk greater than. Now, what does that mean? Well, that means, number one, if it's perfectly correlated, if it's a 1, when the market goes up, it goes up, and relatively by the same percent. When the market goes down, it goes down. If it has a 1.6 or a 2 beta, that means if the market goes up 1, it probably goes up 2. If the market goes down 1, it'll go down 2. So you can see the correlation there. If it has a minus, like a 50 or a 60, that means it's moderately. So it will not go up and down as much. It will be somewhat governed. So it won't go up and down as much with the market, or a typical stock in the market. So what they're saying is the stock portfolio percentage, okay, when it goes, if the stock, okay, is the amount of stock that is invested has a beta of 1, it will go up exactly with the market. If it has a beta of 2, it will double that. So you can watch that. So I think we have an example. It's kind of hard to explain until I have some hard facts here. So the market rewards diversification, as we've known, and that beta is a key point of that diversification. And betas, you can calculate betas, but most stock markets Google Finance page, Yahoo Finance page, they provide that for you. You can get it, and then you'll see how volatile is that share. If it's got a 2.9, you know it really goes up and down with the market, and not in the same percent as the market. It's usually enhanced. So allocation is called asset allocation. Refers to diversifying among different kinds of assets. Okay, so that you can diversify and eliminate as much risk as possible. You can't get rid of it all, but you can get rid of some of it. Now here's your returns, as you can see. This small cap has changed somewhat. It's not returning as much as it used to. So, let's look at this. A conservative investor invests in 20% T-bills, 40% government bonds, and 40% corporate bonds. An aggressive investor invests in 10% T-bills, 50 small caps, lots of risk, 40% common. That kind of is a hedge in a way. So, when we get back here and we look at this, the return for the conservative was 5.42%. The return for the aggressive was 14.24. The difference, money-wise, conservative was 52 million, aggressive was 21 billion, 21.6 billion. And this is if they went over, I think it's a 75-year period, a time horizon, and $1 million initial investment. So you can see how it's very important how you put that portfolio together. It's a considerable amount of money that is different. So allocation matters. Be aware of it. There's a direct relationship between that risk and return, and you want to make sure you have your portfolio laid out as well as you possibly can. Holding periods matter. As we increase the holding period, risk declines. If you look at the stock market, in the last 2 years, you'd say there's no return whatsoever in the market. If you come back and look at that market over a 10-year period of time, you will see that the longer you hold it, the better your returns are, or they level out. And that's what they're talking about with that. And then we look at the investor's required rate of return, and that literally is risk-free rate, which is going to be a T-bill plus the risk premium. Be that the beta times the stock price, or some other risk premium that has been determined by the investor. So that equals, risk premium equals the investor's required rate of return minus the risk-free rate of return. Which brings us to this, it's called capital asset pricing model, but it's actually called, in finances, it's called CAPM model, which helps you determine, okay, the CAPM helps you kind of figure it out, okay, what the expected rate of return on a stock should be, okay, so that you can get a feel for, well, is this really a good buy, or should I maybe pass this one up? The CAPM provides an intuitive approach for thinking about the return on that an investor should require on an investment, given the asset's systematic risk, okay, or market risk. If, and they give us a really good example, if the rate of return for the market portfolio is 12%, and the risk-free rate is 5%, and the risk premium for the market would be 7%, so that's 12. That's the overall rate of return minus the risk-free. So we have 7, a risk premium. The 7% risk premium could apply to any security having a systematic, okay, non-diversifiable risk equivalent to the general market, or a beta of 1. Now that changes if the beta of that security, okay, is 2. So instead of being a risk premium of 7, that risk premium would then be 14. And then you would require a higher rate of interest because of that high beta. That everything hinges around the beta of the stock or the investment. So it's really important to understand that. The beta, the higher the beta, the more the risk, the higher your risk premium should be. Here is the actual formula. You want the rate of return, risk-free, and then you want to take the beta times the required rate of return from the market portfolio minus the risk-free. And it looks like this. Okay? The market risk is 12, the risk-free rate is 5. Okay, so 5% plus the beta, 5% plus the beta times the premium. So if we look at, if beta is 0, if I multiply 0 times anything, I'm going to get 0. So my required return is 5. If beta is 1, if I take this 12 minus 5 times 1 plus the 5%, my required return is 12. If beta is 2, I've got 14 here, 2 times the 7 plus the 5. So I want a return of 19% on that particular stock. Am I going to get it? That becomes the question. So it kind of gives you a little bit of a benchmark to shoot for. Final thing I'm going to show you is what you're going to have to do in the activity in 6.2. You also would have to calculate a CAPM in 6.2. But you're going to be required to create a security market line. And it looks like this. You're going to start with the risk-free, and you're going to move it up to the required rate of return and create a line that shows what the betas are across the bottom, which is kind of nice because then you can compare. And you're going to be asked to do that. You can either draw it or use Excel for that. And that wraps up this chapter. I'm sorry, this is kind of long. It's almost 30 minutes. A lot to think about, so you may have to watch it more than once. Thank you.